What is up, guys, and welcome to another edition of the Market Marauder Show, beating the market one trade at a time. All right, in today's episode, we're going to be talking about banks. So, we're going to be going over the recent bank failures that have been going on, as well as mortgages and what the trends are for the overall banking system itself. So, going back, we have the list pulled up here of the most recent bank failures, concerning a lot of citizens or a lot of Americans overall. We have the last one to report a failure was Republic First Bank. That was on April 26, 2024. If we see the list here, we have 5 banks that closed in 2023, with the most notable one being Silicon Valley Bank. So we're going to go over a brief synopsis of Silicon Valley Bank, which was the most popular one, and then kind of give my opinion on what I feel like the path forward is for the banks. Now, this is from FDIC. If you go to any bank, usually major banks, they have FDIC, which is the insurance that covers your money at the bank up to $250,000. And so this is the company. It's been around for 90 years, and they've been doing reports on the banks that closed. They're a government organization, sort of like the IRS, and they do studies on banks to see what happened overall. So let's go into Silicon Valley Bank and see what really happened. So this is just a review. This came out from the Board of Governors of Federal Reserve System. So it's kind of a deep dive into all the things that happened. I'm going to go over this brief first statement. So SVB, Silicon Valley Bank, failed because of a textbook case of mismanagement by the bank. Its senior leadership failed to manage basic interest rates and liquidity risk. Its board of directors failed to oversee senior leadership and hold them accountable. And Federal Reserve supervisors failed to take forceful enough action, as detailed in this report. So our banking system is sound and resilient with strong capital and liquidity, and in some respects, SVB was an outlier because of the extent of highly concentrated business model, interest rate risk, and a high level of resilience on uninsured deposits. However, SVB demonstrates that there are weaknesses in regulation and supervision that must be addressed. And so regulatory standards for SVB were too low. The supervision of SVB did not work with sufficient force and urgency, containing or from the firm's failure posed system consequences not complayed by the Federal Reserve tailoring framework. And so following SVB's failure, must strengthen the Federal Reserve supervision and regulation based on what we have learned. The report represents the first step in the process of self-assessment that takes an unflinching look at the condition that led to the bank's failure, including the role of the Federal Reserve supervision and regulation. Individuals who were not involved in the supervision of SVB conducted the review, and the person who wrote this article oversaw it. So the 4 main key takeaways from why the bank failed. Silicon Valley Bank's board of directors and management failed to manage their risk. Supervisors did not fully appreciate the extent of the vulnerabilities at Silicon Valley Bank, grew in size and complexity. And number 3, when supervisors identify vulnerabilities, they did not take sufficient steps to ensure that Silicon Valley Bank fixed those problems quick enough. And 4th, the board's tailoring approach in response to economic growth, regulatory relief, and Consumer Protection Act, or EGRRCPA, a shift in the stance of supervisory policy, amend effective supervision by reducing standards, increasing complexity, and promoting a less assertive supervisory approach. So basically, they were like over leveraged in a bunch of like crypto companies, crypto assets. They also had a lot of backing in companies such as, big startups that needed tons of capital that were in the tech industry. And then the tech industry started to take a dive. So once that happened, and then crypto also started to take a dive as well, a lot of those bank notes or loans were not able to be paid off. And a lot of people kind of got wind of that. They started to get audited by the Federal Reserve. They kind of stepped in and were doing their um, kind of research and kind of limited people coming to that bank. And then once, regular citizens came in, they started to panic. And then kind of a small bank run. I wouldn't say an official bank run, but a small bank run sort of started to happen. You saw in the news where people lined up outside to try to withdraw all of their funds from the bank to try to make sure they had money go with a different bank. But it was basically locked down because it was under investigation by the Federal Reserve. So, like I said, FDIC insurance protects all those assets, and people got their money back up to $250,000, but it was bad or poor leadership that led to this. So, hearing about Silicon Valley Bank, I thought it was very eye opening. I personally don't use Silicon Valley Bank, but I think it was definitely a learning experience for a lot of people to show, banks can be mismanaged. Even the people that manage your money can mismanage it, even though you're good at managing your money. So, diversifying, having different accounts, making sure you spread all of your money in different places, have different types of assets, whether that's, um, high yield savings accounts, stocks, real estate, having multiple accounts with that $250,000 limit. You can open up different accounts that are all FDIC insured, so at least that capital is insured. People start thinking about different ways to invest their capital after that situation happened. Now, as we saw on the list, SVB was not the only one that was impacted. There were a couple of other company or a couple other banks that were impacted from that, and then ultimately, I think what has happened as well is interest rates have definitely played a part into that. So the next section I want to talk about is about mortgage rates and mortgage delinquencies. So the delinquency rate for mortgage loans for 1 to 4 unit residential properties increased to a seasonally adjusted rate of 3.88% of all loans outstanding at the end of the fourth quarter of 2023. And this is according to MBA or Mortgage Bankers Association's National Delinquent Survey. The delinquency rate was up 26 basis points from the third quarter of 2023, but down 8 basis points from 1 year ago. The historical average for the seasonal adjusted mortgage delinquency rate from 1979 through 2023 is 5.25%. Of particular note, FHA delinquencies were up 131 basis points. The percentage of loans on which foreclosure actions started in the fourth quarter remained unchanged at 0.14%. And so, looking on the chart down here, one of these quotes is the labor market is still quite resilient, with the unemployment rate strongly correlated with mortgage performance, remaining at 3.7% in January. Any weakening employment conditions would likely lead to borrowers falling behind on their payments in the coming quarters. So, if we look at the chart overall, we can see FHA loans percentage wise is 10.81%. So, almost the largest it's been since around 2020. But 2020, we had, different issues that are going on in the world. So it's kind of like excusable, but it's starting to rise back after that. So kind of the lowest was right before 2020, and then 2020 happened, and then we see it jump back up to 10.81%. And so another economic time to note was 2008, 2009, when we had that financial market crash that was also at high. It was at around 14.1%, but 10.8% going back towards 14% on FHA. You also have high levels for just all loans in general and VA loans and conventional loans. Conventional loans are at 2.61%. And this is towards the end of 2023, so this has been updated since then. Just keep that information in mind. And then for all loans, you have 3.88%, and then for VA loans, it's 4.07%. Now, I think these numbers have gone up tremendously as we, going further into 2024. But I think this was interesting to see, they were already starting to rise towards the end of 2023, and now into 2024. I think that the numbers will continue to grow as there are more delinquent people on loans. And so that effectively hurts the banks themselves because for all the money that they get from you, they go and lend out a portion of that money to someone else in the form of loans, and they get paid from that interest. And that's kind of how the bank system flows. The next bigger portion of that is very alarming, and why I think a lot of these banks are becoming insolvent, is commercial real estate. So with the birth of work from home, a lot of people weren't going back to work, and so if there's no one in the office, a lot of those offices close down. But there are also a lot of companies that own those office spaces. So large banks are facing higher risk from commercial property loans, sparking increased concerns. So the commercial real estate loan portfolios of the nation's biggest banks are facing increased risk. New federal data shows, with an estimated 1.6 trillion in property financing expected to mature over the next 2 years. More than 65 of the largest U.S. banks are at high risk of failure because of their commercial property loan exposure, according to Florida Atlantic University analysis for the first quarter data. The 67 banks with more than 10 billion in assets have exposure to commercial real estate greater than 300% of their total equity, based on the data report to regulators. And the analysts also found any ratio over 300% is viewed by the Federal Reserve as excessive exposure that could put the banks at greater risk of failure. So basically, they're over leveraged, meaning having a diversified portfolio. 300 percent of the portfolio is in commercial real estate. So that kind of was their big cash cow for getting money in, instead of just home loans. Maybe home loans is 1%, but 300%, meaning they're very over leveraged as far as the amount of commercial real estate that banks are invested in. And 67 banks would be impacted by that, with the $10 billion in assets that they are exposed to. For comparison, fourth quarter industry average for commercial real estate loan exposure was 139% of total equity. The study found the far high exposure from big banks is sparking concern because it comes at a time increased interest rates to fight what's proving to be persistent inflation and some lower demand, analysis and regulators say. So when they switched from, going into work, everybody was used to their normal commute, to then working from home, and, a lot of companies canceling their lease. Well, the bank has to have that property or they have to sell it. So with the bank being the renter of that facility, they have it under contract. Once that lease is up and that company is gone, then it's just a vacant building and they're no longer getting money from it. But there are only two things they can do: is find another renter, or to get or to sell that property. And so, since the work dynamic changed and no one's going to work and people working from home, there are not really a lot of companies that are looking for commercial spaces. So they're kind of stuck with it, and there are not many people who are looking for commercial spaces to move into or to lease. So it's kind of like a dead asset. It's kind of a float, I would say. And so that's something that a lot of banks are facing, which could affect your capital. So if the bank is not getting this recurring money coming in, then that's less money that they can give to you, or less mortgages or loans that they're able to dish out because they haven't gotten their money back on the back end from the leases that they have for the commercial real estates. And that's, one of the reasons why these banks become insolvent. And so this is the FDIC quarterly banking profile for the first quarter of 2024. This is done every quarter. But I thought there was some interesting information in here talking about kind of foreshadowing events on the potential insolvency of some more banks. And so the bank industry net income was 64.2 billion in the first quarter, was an increase of 79.5% from the prior quarter, mainly due to lower expenses related to the FDIC special assessment and lower goodwill write-downs. Otherwise, the net income of the first quarter would have increased 14.3% from the prior quarter, as high as non-interest income and lower provision expenses were more than offset a decline in net interest income. So community banks reported a net income of 6.3 billion, quarterly increase of 6.1%. The industry's net margin declined by 10 basis points Uh, the industry's net interest margin declined by 10 basis points to 3.17%, below the pre-pandemic average of 3.25%. Continued deposit uh, completion caused funding costs to increase during the quarter, while its yield on earnings assessed decline. So I think one of the most important parts on here that I think is very alarming for everyone to really pay attention to and kind of worrisome about the future of this banking system is unrealized losses on available for sale and held to maturity securities increased by 39 um, increased by 39 billion to 517 billion in the first quarter. So unrealized losses. So going from 39 billion as a projected loss to 517 billion of a loss is definitely a huge difference. Higher unrealized losses on residential mortgage-backed securities resulting from higher mortgage rates in the first quarter drove the overall increase. This is the ninth straight quarter of unusually high unrealized losses since the Federal Reserve began to raise interest rates in the first quarter of 2022. So, like I said earlier, explaining the delinquency on mortgages, this is becoming like a large stockpile of losses that the banks themselves are feeling directly, with the projection changing from 39 billion to 517 billion. The industry's total loans declined by 35 billion to 0.3% in the first quarter. Most of the declines was reported by the largest banks, in line with seasonal decline in the credit card loans or lower auto loan balances. The industry's year over year loan growth rate of 1.7% is the slowest rate of annual growth since the third quarter of 2021 and has steadily declined over the past year. The annual increase was led by credit card loans and CRE loans. Loan growth at community banks was more robust, increasing 0.9% from the prior quarter, 7.1% from the prior year, led by CRE and residential mortgage loans. So basically, meaning a lot of people are going to smaller banks than larger banks. But having such a large unrealized gain, going to, or unrealized loss, I should say, from this 39 billion to 517 billion, I think is something very concerning. And then also they kind of outline saying higher unreleased or unrealized losses on residential mortgage-backed securities resulting from higher mortgage rates in the first quarter drove the overall increase. So they're saying they have a lot of unrealized gains from these residential mortgage-backed securities. You tie that information in with the mortgage delinquencies, and you kind of have a problem. Depending on how much float that's going on in there, if the companies have over leverage of large banks, or large banks over leveraging commercial real estate and that money not coming in, then you also have defaults on residential mortgages. That's kind of a recipe for disaster. Um, so definitely make sure you go check on that list for different banks. I suspect there may be more banks in the future. They may have a potential for being insolvent, but remember, there's FDIC insurance for most banks, so you are covered up to $250,000 in your account. And also make sure you diversify. Like I said earlier, diversification is a great way to grow your accounts in the future. Make sure your money is spread out in different places so that you can be safe if your bank does crash. I know a lot of people with SVB or Silicon Valley Bank were kind of caught off guard, and then it kind of messes up a lot of things. If your check is being direct deposited to there, but the Federal Reserve is locking or freezing all those accounts, you're kind of stuck. You don't really have the money to do those different things, whereas you would have a different account or have an investment account somewhere. You kind of have it diversified and you can float yourself until that issue is resolved. So hopefully that information helped you all out. Make a more informed decision. Make sure you check your local bank for FDIC insurance. It will definitely help. And drop a comment down below. Tell me, do you guys think that more banks will be failing as we continue on in 2024? What banks do you see are kind of on the line or teeter-totting before they potentially are going to go insolvent, make sure you drop that comment down below, and I'll see you guys on the next one. Peace.